This is the Economic Club of Florida, a distinguished platform for discussion of the major national issues of the day. On today's program, Scott Kupor with the venture capital firm Andreessen Horowitz and their multi-billion-dollar bet on W3, the next generation of the internet and cryptocurrency.
The key distinguishing features of Web3 relative to its predecessors is that platform is decentralized and open, meaning nobody owns it, and it's anybody who wants to be a publisher to that platform is able to do so, and it's not really controlled by any central resource. So that freedom and that flexibility is what we think kind of is very attractive to developers in this age.
Good day and welcome to the 558th in our series of distinguished speaker programs. I'm Harvey Bennett for the Economic Club of Florida. We're very happy to have with us today Scott Kupor, investing partner with Andreessen Horowitz. It's a venture capital firm in Silicon Valley, California, with $33 billion in assets under management, which describes itself as backing bold entrepreneurs who are building the future through technology. Scott, welcome.
Thank you. Glad to be here, Harvey.
One of those new technologies that you're backing is something called Web3, described as the future of the internet. Tell us about Web3.
Sure. Yeah, you may hear it as Web3. Sometimes people call it crypto, blockchain, all kinds of related terms. But in very simple terms, the way we think about Web3 is it's really a new development platform on which lots of different applications we think will be built over time. And the key distinguishing features of Web3 relative to its predecessors is that platform is decentralized and open, meaning nobody owns it, and it's anybody who wants to be a publisher to that platform is able to do so, and it's not really controlled by any central resource. So that freedom and that flexibility is what we think kind of is very attractive to developers in this age.
And that will compare and contrast to the version of the web we're in right now, which tends to be and is criticized as being big tech heavy, with several companies controlling a lot of it.
Yeah, that's right. And what's interesting is, the history of the web or the internet was very open. A lot of the early standards were all open standards. They were governed by, in many cases, academic bodies, but it was very open. And you're right, what we've kind of called Web 2, which is really the current version we're in, has really been dominated by a number of kind of platforms. So, many of you know the names of some of those companies. And look, there's been a lot of benefit from that, but also the challenge is if you are an application developer, it's very hard for you to kind of build on those platforms and feel as though you really kind of control your own destiny. And that's really what Web3 is about, is enabling that opportunity for developers, but giving them the opportunity to feel as though the platform itself is an open and decentralized platform that they can feel confident building on.
Understood. Okay. Now, your firm, Andreessen Horowitz, which is also known as A16Z, has a venture capital fund called A16Z Crypto that invests in both the Web3 that you just talked about and cryptocurrency startups. Tell us, how is this new distributed and decentralized internet that is Web3 going to help cryptocurrency, which has certainly been in the news a lot lately?
Yeah, I think these terms sometimes make things more confusing than need be. Here's the simple way I think to think about a cryptocurrency is, and you may hear the word token often used as a way to describe it. What Web3 really is this open, decentralized development platform we've talked about. And then what the currency part of it is really just introducing an economic model that is often, identified in the form of a token that is specific to, a particular application. And the way to think about that is, in today's world, if you are somebody who contributes to the development of a platform. So let's say if you, for example, were part of Uber and you were an early driver, obviously you got paid, of course, to be an early driver, but you didn't have a form of appreciation of the opportunity, the economic opportunity, as Uber grew and developed. And what the idea of a cryptocurrency or a token does is really create an economic opportunity for those people who are the people who help grow the network, who help govern the network. And so it really creates an economic incentive that enables the participants of the network to feel as though they ultimately can be compensated for the value they bring to the organization.
Gotcha. And I know you're certainly going to get a lot of questions from our club members in a few minutes about cryptocurrency as part of your upcoming address. But tell us a little bit about yourself. Let's talk about you, how you got to where you are. You have a very interesting blend of experience in both the software industry and in venture capital investment.
Yeah, well, I appreciate that. The simple way to describe my life is I've been very, very lucky to meet some great people along the way, and hopefully been smart enough to take advantage of opportunities that has provided. But very briefly, I am a reformed lawyer turned investment banker, and had the pleasure of taking many companies public in what was the dot-com boom and bust, unfortunately. Most of those companies you probably never heard of because many of them don't exist today. And then I had a random introduction to Mark Andreessen and Ben Horowitz in 1999 when they started a company called LoudCloud. And the company was literally a month or two old. And I kind of got the fever, the startup fever, and decided to join them. And we ran that business until selling it to Hewlett-Packard in 2007. And then we started this business, the venture capital business, in 2009. And we've had a really exciting 13-year run. So most of my history really goes back to this random introduction that I had to these two really interesting entrepreneurs. And as I said, I was smart enough to not say no when they offered me the opportunity to be part of that journey. Timing is everything, as they say, right? Absolutely.
Scott Kupor, investing partner with the venture capital firm of Andreessen Horowitz, or A16Z. Thank you, sir. We certainly look forward to hearing the different investment opportunities you're going to outline to the club in this fascinating, cutting-edge field that touches so many parts of our lives.
Thank you, Harvey. I look forward to it.
Now, here's John Bradley, Secretary of the Economic Club of Florida and Senior Investment Officer for the Florida State Board of Administration, with our formal introduction.
Good afternoon. It's great to be here today, and it's my pleasure to introduce and lead a conversation with today's speaker, Scott Kupor. Scott Kupor is an investing partner at Andreessen Horowitz, where he is responsible for all operational aspects of running the firm. Founded in 2009, Andreessen Horowitz is one of the largest and most successful venture capital firms in the world, currently managing over $34 billion across multiple funds. Prior to joining Andreessen Horowitz, Scott worked as Vice President and General Manager of Software as a Service at Hewlett-Packard. Scott joined HP in 2007 as part of the Opsware acquisition, where he was Senior Vice President of Customer Solutions. In addition to his board seats affiliated with Andreessen's portfolio companies, Scott is chairman of the board of Genesis Works, board member for the Global Impact Investing Network, and lecturer at Stanford Graduate School of Business. He has also served as chairman of the National Venture Capital Association, co-founder and co-director of the Stanford Venture Capital Directors College, co-founder and co-director of the Stanford Rock Center's Guide to Venture-Backed Board Membership, an executive in residence at Haas School of Business and Bolt School of Law. Scott graduated Phi Beta Kappa from Stanford University with a bachelor's degree in public policy with honors and distinction. He also holds a law degree with distinction from Stanford University and is a member of the State Bar of California. Scott, it's a pleasure to have you here with us today, helping us to better understand the very misunderstood topic of Web3 and cryptocurrencies.
Thank you, John, and thank you, Ela, for hosting us here. Appreciate the opportunity.
Great. So Scott, maybe before we begin, perhaps maybe tell us a little bit about your firm, Andreessen Horowitz.
Yeah, sure. Let me just give you a very quick introduction. So we are a multi-stage investor in the broad venture capital space. We invest in anything where software is the foundational piece of the business. So that could be anything from an enterprise company that might sell into other businesses to a company like an Airbnb, for example, in the consumer space. And then we also have practices in the life sciences area, in crypto, as we'll talk about today, of course, and then gaming is another area that we spend time in. So you'll see us investing anywhere from several $100,000 at a very, very early stage where a company is really just being formed to as much as $250, $300 million as a company scales, still as a private company. So it's a fun place to see lots of interesting entrepreneurship and innovation happening, and very happy to be able to experience that.
Yep. Thank you, Scott. So we have no shortage of topics, and my hope today is we cover a lot of things Web3. So we'll talk about digital assets, blockchain, DeFi, possibly some regulation and current market conditions. But before we go too far, maybe we'll start with some definitions. So first, let's start with the technology that underpins Web3, the blockchain. So Scott, what is a blockchain?
Yeah, great. And as John, I think this is great. Hopefully the goal today is to provide some basic definitions and framework to help people understand why we think as a venture capital firm, this is a very interesting investable area. So let me start with blockchain, as you mentioned, John. So this is a term that for those of you who follow the space, you will hear lots. It's really important, I think, to just fundamentally understand what we're talking about here. When we say a blockchain, what we intend that to mean very simply is a computer that lives in the sky. So let me try and kind of break that out for you for a second. So what's a computer? A computer really does two things. A computer is a place where you can store data. So a computer has memory, and therefore you can store a state of information. And then a computer is also something where you can also act on and change the state of information. That's the very simple definition of a computer way back, from the days where von Neumann kind of identified what the architecture was. So a blockchain is really just basically this computer. It can store state and it can kind of change state that happens to live in the sky. Now, if you look at blockchain compared to an existing computer, there are a couple of fundamental properties of a blockchain that are different from a traditional computer. Probably the most important thing is that in a blockchain, the computer program itself is really kind of the driving engine of what changes in the system. So what I mean by that is in a normal kind of company, there are people who ultimately are creating software programs, and people, of course, can define what the properties of those software platforms are. When we think about a blockchain, we're really talking about kind of the software being kind of higher than or more important to the humans. In a sense, the software is, we tell the software what we want it to be, and then the governance and the runtime of that software is governed by what has been coded there. So the key function and key property, therefore, of a blockchain is that the code is autonomous and it continues to run. So in effect, you are trusting software to make decisions as opposed to trusting humans to do so. So that's kind of one area. The second area, which we can talk more about, is the concept of decentralization. So again, in a normal company, we have a board of directors, we have kind of managers that determine kind of the decisions on behalf of the company. One of the key properties of blockchain, as we think about kind of the broader Web3 world, is this idea of decentralization, that the governance of those systems is not governed by a centralized organization, but it's governed by the mix of people who are responsible for ultimately developing software and organizing the runtime for that environment. And then the final piece, John, to help people understand, is the concept of open access. And so we'll talk a little bit more about this when we talk about open source more generally, but the other kind of fundamental principle of blockchain is that it is open. In other words, what that means is if you or I wanted to create, kind of the Florida Economic Club, version of Bitcoin tomorrow, all of that code is accessible, it's public, it's out there, we can just download it and obviously make whatever changes that we want to. That's different, of course, from most software that all of us interact with on a day-to-day basis, which is kind of proprietary and closed. So those are kind of some of the key elements when we think about the broad concept of blockchain, which really underlies the kind of crypto and Web3 discussion that we're going to have today.
Yeah, thank you, Scott. So we often hear the terms crypto and Web3 used somewhat interchangeably. Does that make sense, or are there differences between crypto and Web3 that would be helpful for us to understand?
Yeah, I think there are. So I think a simple analogy and way to think about this is to analogize to kind of how the traditional kind of internet stack works. And I think we can hopefully use that as a way to kind of compare the way the crypto and Web3 operations work. So if you go back to the foundations of the internet, one of the first basic building blocks of the internet were kind of a set of core protocols. So some of you may have heard of things like TCP/IP, which is kind of the protocol that governs kind of networking traffic on the internet. Some of you may have heard of SMTP, which is really kind of the underlying protocol that governs our email today. So things like whether you're using Gmail or you're using Microsoft Exchange, it's running on a very low-level protocol called SMTP. And we think the analogy of these protocols in the modern world is those really kind of, when we say crypto, we're thinking about kind of new versions of these core protocols that really kind of underlie the system. And then if you think about the internet, on top of those protocols, there was a whole set of technologies that were built in order to enable people ultimately to build applications. So HTML and Java, various other kind of programming languages that allow you to kind of utilize those core underlying protocols to create ultimately what has now become the internet. And that's really how we think about Web3 in a broader way, which is Web3 is really the combination of the core underlying protocols, so the blockchain in this case that we talked about, plus a set of technologies that will ultimately, enable people to build applications on top of that protocol. And then finally, just to kind of complete the analogy, if you think about this, on top of all those will be applications. So today, right, we have, an internet, and that internet is riding upon these core protocols, but ultimately you have applications that live on top of that. You have Facebook, you have Google, you have all kinds of other things that live on top of that. As we think about the broader Web3 stack over time, you will have all of those components. You'll have the protocols, you'll have the sets of technologies that enable people to build on top of those protocols. And then over time, we will have a set of applications that, many of us as users can use. So think of it almost as analogous to kind of this broader technology stack that we've dealt with previously. Now, there's one other kind of addition that I would kind of add to this that didn't exist in prior internet platforms. And this is the concept of kind of a token. This is what sometimes people refer to as cryptocurrencies when you hear them kind of referring to it in that context. And what the token is it really just basically introduces an economic model on top of those core foundational protocols. And so that enables people to be, kind of participate in the kind of economic rewards of that system in the form of a token. That's something new that didn't exist in prior generations. So kind of when we think about core internet protocols, there wasn't a way for people to monetize them at that level. So there was never a company, an SMTP company, for example. There were other, for-profit organizations like Microsoft and Google and others who built on top of those protocols. But the token that we introduce, and again, this cryptocurrency that many of you hear about, really becomes kind of the economic engine that underlies a lot of this kind of modern framework.
Maybe as we think through Web3, maybe we can talk through how this relates to maybe Web 1.0, Web 2.0, and maybe prior arcs of innovation in the industry.
Yeah, let me give you a couple examples here, because I think for many people who are hearing this stuff for the first time, it's always sometimes easier to kind of view this in the context of kind of historically, what have we seen in the development of other platforms? And there's two, I think, really foundational things to talk about here. Number one is the concept of open source software. So I mentioned that one of the characteristics of a blockchain is that it's open, that if you and I decide we want to kind of download the software today and start building our own set of Web3 protocols, we can do so. Open source is not a new concept in technology. This has existed all the way back into the 1980s. There was a very famous professor at MIT called Richard Stallman, who created something at the time that was called the free software movement. But the basic idea behind open source was, I would really call it the wisdom of the crowds. The idea is if you have a system that is open, that enables lots of people to be able to contribute to that system. And over time, the system kind of becomes better as a result. Essentially, what it creates is kind of a concept of composabilities, right? So if I write something for the first time and you want to build something new, you can get the benefit of kind of riding on top of the rails that I've already created. You can essentially take these Lego blocks, these building blocks, and ultimately create them. And open source, in many respects, if you look at the kind of arc of technology, has really become a dominant platform in technology. So many of you are, using your iPhones or Android phones today. A lot of what runs in those phones is open source software. If many of you have data centers or you have kind of corporate institutions, you're probably running versions of Linux, which is another open source platform. So kind of some of the roots of what we see in blockchain really goes back to kind of the original open source side of things. The second thing is kind of what I mentioned before, is this concept of kind of base level protocols that are also open and available for people to work on. So as I mentioned, protocols that we talked about like HTTP or SMTP, these are foundational internet protocols. When those were first developed, they were open. So number one, people could obviously, see them and, use them to kind of build on top of. And they were also governed by kind of open bodies. So in many cases, either academic institutions or foundations, they were kind of, responsible for governing these. And so what you had was a basically set of core and open protocols with a governance model that was well known to people. And this is what ultimately enabled the development of the internet. So the reason why people could develop applications on top of these foundational protocols was because they understood how those protocols worked. There was lots of publications about how to manipulate them, and there was no concern that some kind of company might change those protocols in a way that could be deleterious to users. And so the way to think about kind of the evolution then of technology is we had kind of Web 1, which is really kind of, mid to late 1990s. This was really what we would call kind of the ability to read things on the internet, right? So if many of you remember the applications that existed at that time, it was basic, media properties or other things like that. That was kind of the early versions of Web 1. Web 2, which is really kind of the era that we've been living in since then, really also then created a whole new set of application developers who enriched those foundational protocols by building apps on top of those platforms. And so if you think about that, kind of all the applications that we've all come to know and love, whether it's, Facebook or other things like that, those are all developments on top of those core platforms. And then Web 3 for us then is really just a natural evolution, which is it enables kind of all the things that Web 1 and Web 2 did. But if you recall, I mentioned this concept of a token. And what the token does then is really just add to the basic foundation by creating a sense of kind of ownership and economic alignment that didn't exist kind of in these prior eras. And so when you hear Web 3, again, you kind of have to hear it a little bit in the context of kind of the prior versions of the internet that came before that. And again, the key differentiating factor here is the introduction of an economic model that we'll talk about more, but that enables the kind of producers and contributors to an application to be able to kind of also enjoy in the economic success of those models.
Yep. Thank you. And then so maybe before we leave this point, maybe we just touch on the other aspect of Web3. And I think one that gets most people excited, or at least early adopters, the concept of it's a decentralized web, right. So decentralization.
Yeah. So again, it's a great point, John. And again, just to kind of, create the historical analogy, kind of in the old days of these original protocols on the internet, they were decentralized in the sense that there was no kind of, for-profit corporation that owned or governed them. As I mentioned, many of them were kind of just governed by either, public foundations or academic institutions. The concept of decentralization is really interesting because it comes to light when we're also talking about kind of some of the challenges of centralization that have happened in the Web 2 properties. So if you look at, many of the bigger organizations today, Google and, Microsoft and others, one of the concerns that, you hear from politicians and you hear from, other people in the community is that kind of what was a very open internet now has become closed in some respects because these platforms have become so important. If I'm an application developer, I have to think about how my application runs on Google or Apple or Microsoft or Facebook and others. And, if you talk to developers, what they worry about is if I build on top of those kind of platforms, then I worry that maybe at some point in time, a decision gets made by those organizations that could impact my application. Maybe they change the terms of service, or maybe in the case of, for example, Apple, they charge a certain amount of economic rent for you to be able to access their platform. And we've seen this kind of in previous generations of technology as well, where kind of as platforms become more and more powerful, understandably so, sometimes they kind of are at odds with the application developers who like to live and ride on top of those platforms. And so in some respects, you can think of the broader Web3 movement and this decentralization as a little bit of the free market antidote to concerns around concentration among these platforms. And so in the case, again, of Web3, as opposed to having a single company that controls the platform, all of these organizations are decentralized. So governance happens by somebody is a token holder and they can vote on changes in the governance model. So you almost have kind of a direct democracy in many respects that ultimately controls kind of, what these platforms do and ultimately what the properties of these platforms are. So that concept of decentralization and therefore application developers not having to worry about changes by a central organization that could impact their applications is a really important fundamental underlying feature of Web3.
Yeah, thank you. I think, and that was a great overview of what is a very, very complex topic. Now
we'll see when we get the results from the audience on whether they understood it or not, but I appreciate that.
Yes. So now we'll move to the term that I think most, or at least most in this room have at least heard of. So cryptocurrencies. So what are cryptocurrencies, and maybe more importantly, what are they not? And so are they really currencies?
Yeah, so the answer is, kind of yes and no, depending upon which aspects of cryptocurrencies you're talking about. So let me hit on a couple things. Let me talk about the fundamental idea behind cryptocurrencies, which is really this idea of enabling what I'll call digital money. And so this is actually not a new concept. In fact, way back when in 1983, there was something called DigiCash, which people may not remember. There was something called eGold in 1996. And basically, these were ways that people were trying to program essentially digital money into what ultimately became the internet. And in fact, my partner, Mark Andreessen, who was the inventor of the Netscape browser, which kind of became obviously the primary browser in the internet area, they considered also adding basically a form of digital payment into the browser at the time. The reason ultimately I believe that didn't happen was the internet was really still largely a government-funded activity. And so the idea of kind of adding a commercial layer into it was something that was a little bit just kind of anathema to the original developers of the internet. But the basic idea is, how could we make it easier for people to basically, transact using digital money? And for those of us in the States, we are, spoiled in many respects. And so the problem may not be obvious to us, but if you look broadly across the world, there's about something like 1.7 billion people in the world who are unbanked, meaning they don't have bank accounts, they don't have credit cards, and therefore, kind of they're outside the rails of a lot of the kind of modern financial system. Things like PayPal, for example, for those of you who use that, you might be surprised to learn that PayPal doesn't work in many countries today outside the U.S. And so the basic fundamental premise of kind of digital money is to make it easier for people to basically be able to effectively transact on the internet. The way we do that today is we get money, we transfer money across from the unbanked to the banked through things like global remittances. That's a very expensive and inefficient way to do it. And so this is kind of the fundamental concept of the cryptocurrencies is some form of digital money. Now, you mentioned, John, the concept of Bitcoin, for example. Bitcoin is one example of a cryptocurrency. There are many of these. There are hundreds of them. Some of you may have heard the word Ethereum. Ethereum is another form of cryptocurrency. And what those currencies do is they enable people again to kind of transact on the internet using kind of those currencies. And they also, as I mentioned, for the participants in the communities, really enable them to be able to participate in the foundational economic successes of these businesses as well.
Thank you. And so we'll move maybe to DeFi. One of the more developed areas of blockchain technology, maybe outside of cryptocurrencies, and what's likely a bigger opportunity is decentralized finance, or as it's often called, DeFi. I know some of DeFi's biggest supporters say it's going to disrupt the banking industry. It's going to change the world's financial system. And so how would you describe DeFi to those of us unfamiliar with the term? And maybe if you could give us some real world examples of DeFi in use today.
DeFi, just to kind of frame where we are, right? DeFi is what I would call an application in the Web3 environment. We've talked about kind of, protocols and infrastructure. DeFi now is an example of an application that lives. And the way to think about decentralized finance at its highest level is, kind of trying to create a new financial system that takes advantage of a lot of the underlying properties of the blockchains that we've been talking about. So the fact that they're decentralized, the fact that they're open source, that is really kind of, the main idea. In most financial systems today, right, you have centralized bodies, right? You have banks, you have, wirehouses, you have lots of different kind of players, and ultimately they are intermediating those transactions. So the fundamental premise at scale of something like DeFi is to enable kind of the computers and software to be able to be the methods of intermediating those types of transactions, as opposed to having to go to central clearinghouses or institutions to be able to do that. So if you think about what the broader financial system does today, there are things like exchanges, right, where you can for example buy and sell stocks as part of exchanges. There's cross-border remittances, there's lending, there's borrowing, there's derivatives, there's market makers. Obviously, there's all kinds of components that comprise the traditional financial system we have today. So this doesn't yet exist at scale, but over time, if decentralized finance is going to kind of grow and live, it will ultimately have to replicate all of those individual functions that exist in the traditional financial system today. And it will do so using kind of these decentralized platforms that we've been talking about. So maybe I'll just give you, one or two examples. So, and both of these are companies that we've been invested in. One is a company called Compound, and Compound basically is creating opportunities for people to borrow and also to lend cryptocurrency. So if I have Bitcoin today, and I want to be able to, get access to Ethereum, which is another type of cryptocurrency, you could go through a system like Compound and be able to borrow and lend against those, and be able to in many cases earn an interest rate for you. You're creating a market, basically. You're creating a liquid market for those currencies. Uniswap is really a decentralized exchange. So Uniswap, if you have US dollars today and you want to convert US dollars into some form of cryptocurrency, Uniswap is an example of a decentralized exchange that could do so. There are examples of centralized exchanges like Coinbase, for example, which is a company that we also invested in many years ago that do similar things. But that's the basic framework, which is think about the core traditional financial system today. Are there ways to build basically a parallel system that incorporates these fundamental technologies of decentralization and open platforms and tokens into a more modern Web3 decentralized finance organization?
Yeah, thank you. And so we've talked a little bit. You mentioned cryptocurrencies really as a way to enable digital dollars or digital money. It's been reported that a number of countries are exploring the possibility of creating their own central bank digital currency. In fact, China has already created and is testing its version of a digital renminbi. So might we see a U.S. Federal Reserve-backed digital dollar in the future? And then what impact would a true digital dollar have on DeFi or even cryptocurrencies in general?
Yeah, this is really interesting. So, I think this is an interesting indication of the seriousness with to your point, central banks and, even just financial institutions more broadly are thinking about these digital currencies. The current state today, as you probably know, is we do have an executive order from President Biden that is encouraging the various financial institutions in the U.S. to think about basically what would a U.S. central bank digital currency look like. There's not a whole lot of detail behind that. You're right that the farthest along we've seen so far is that China is actually has created it and is in fact even testing a version of its digital currency today. I think it'll be interesting to see what happens. There's I think two parallel paths here. There's one is this role of potentially, central governments creating basically, a form of digital currency. I think that will still, if that happens, that will still live in parallel to the broader set of digital currencies that are being developed, primarily in the private sector today in Web3. One of the things I think, though, that's interesting that we've learned, through COVID and through lots of different changes in the broader global economic sphere is that in many cases, access to technology really becomes a national security issue for, sovereign governments, and also really the venue by which people think about economic independence and growth. And so, one of the things that I think the U.S. has traditionally done very well is we've always found ways to encourage the development of new technologies and make sure that the U.S. continues to be a very, very, forward-looking country and the place for, great entrepreneurs to come and start their businesses. And I think in many respects, what the U.S. is trying to do as they talk about things like a central bank digital currency is to at least find ways that the government can help foster the development of, these new frontier type technologies. What the impact will be on, other cryptocurrencies is still TBD. My suspicion is, again, these will coexist alongside other digital currencies that are part of, broader crypto systems. But I think it's a positive sign that the U.S., views the underlying technology as important enough for them to, invest some cycles into determining what might a, U.S.-based central bank digital currency look like.
Yep. Great. And I guess with that focus by the U.S. on the underlying technology, then comes the question around regulation. And so cryptocurrencies in DeFi, they're largely unregulated today. There have been a few high-profile instances of fraud and failures in DeFi. With the failure of Luna, I know you mentioned stablecoins earlier. Luna was a stablecoin, being a recent example of a large-scale failure. And so what's the state of regulation in the crypto industry today?
Yeah, right. It's a great question. And look, I would say as a participant in this industry, one of the things that we've been spending time on, and we have a whole dedicated team, John, as you know, to the crypto space, is really to try to spend as much time as we can in DC, as well as at the state level, talking to regulators about what we think the underlying positive, technological use cases are, but also, quite frankly, recognizing that regulation plays a very important role in making sure that we have consumer protection to go along with that. So you're absolutely right. The way I would describe it today is the SEC has been the major body who's tried to focus on regulation. most of that regulation has been in the form of enforcement. In other words, the enforcement division of the SEC deciding that certain things, violate, underlying, economic laws or principles we have today. And they've done a good job, I think, actually, of rooting out, quite frankly, bad behavior in the system. And unfortunately, bad behavior, I think, is always going to be part of a new economic model. There's always going to be, opportunities for people who may not be, completely scrupulous actor to try and take advantage of new systems. And we've certainly seen some of that in this space. The big kind of broader debate is a longer term question, which is, what is the role of the SEC relative to other regulatory agencies? So the SEC, as you know, obviously given its name, is focused on securities. And there is a fundamental underlying question in the market today as to how do you define a cryptocurrency? Does it actually follow the traditional definition of a security, in which case, obviously, the SEC should be the right place? Or is it something different, in which case the CFTC, for example, might be the more appropriate regulatory body? And then the third place, of course, that's relevant here is because this touches on, issues of currency and national sovereignty, the Treasury Department, kind of also becomes relevant here. So things like, anti-money laundering laws and, know your customer rules, all those things are relevant. So the short answer is it's a very, very uncertain environment right now. Those of us, again, who are active participants are trying to be as active as we can with members of government to really help define the kind of rules of the road. There is a new bill that was just introduced in the Senate that kind of attempts to do that. We'll see, obviously, how these things progress over time. But for this to be successful and important part of economic growth over time, we as market participants do believe that an appropriate regulatory framework does make sense for these types of activities.
No, absolutely. So there's been a number, we mentioned Luna, but a number of companies failing. There's been lots of questions, frankly, about the technology of Web 3.0. So you hear things like the transaction speeds are slow. There's some obvious ESG issues around proof of work, which is the consensus protocol behind many of these blockchains. And so, Scott, what gives you confidence that all this will work?
Yeah, so what gives me confidence is actually a little bit going back to the earlier discussion we're having is it's really what we're seeing here is a very common arc of technological development that we see in lots of new areas. So my partner, Chris Dixon, describes it this way, which is oftentimes these early technologies, quite frankly, they look silly. They are things that people are tinkering with on the weekends, they're hobbies. And then over time, ultimately, what happens is, many of these technologies ultimately become mainstream over, a course of development. There's a very famous quote by a guy named Max Planck, who was a German physicist in the mid 1800s. And the quote is something like, "Technology advances one funeral at a time." And what he means by that really is the idea that kind of what happens is these kind of things have to kind of become ingrained in the kind of, zeitgeist over time. And what looks like silly things initially can ultimately become mainstream technologies. So what we're seeing right now is, I think, a natural evolution of any kind of, common market, which is at first, you have a lot of kind of experimentation. Unfortunately, as we mentioned, you do have some cases where there are unscrupulous actors. But oftentimes what happens is as these things gain critical mass, they ultimately kind of can grow into mainstream activities. Just to give you a sense of where we are, if you look at the number of Ethereum users today, the range is kind of broad, but it's somewhere between 10 and 50 million, 50 million is kind of what people estimate is the number of people using Ethereum today, which is one of the cryptocurrencies. That basically, if you look historically, is kind of what the internet population looked like in 1995. So in 1995, you had roughly 50 million kind of users of the internet. And for those of you who remember those days, as I do, you did these crazy, you had to go through these dial-up modems. You had this horrible screeching sound. Of course, the, kind of utility of it was very limited. And many people at that time also said, hey, look, this thing will never work. It's slow relative to other things we have. So this is a very common refrain in the development of technology markets that early instantiations of things often don't look interesting. The other funny quote I'll give you is, when the iPhone came out in 2007, Steve Jobs was rolling this out to a broad segment of people, and they did a press conference. And one of the reporters said, "This thing will never work because every time I use my thumbs, and he was, articulating and gesticulating with it. Every time I use my thumbs to try to type, I make a mistake, right? My thumbs, can't quite figure it out." And it's a really interesting idea here again, because of course, what happened over time is people became used to it. And Steve Jobs actually responded to this report at the time. And his answer was, your thumbs will learn. That was basically what he said to this reporter. And I think that's, again, what happens in a lot of these technology markets is at first, the initial instantiations of products often tend to be inferior in many cases to existing technologies. But what they do is unleash a wave of entrepreneurship and innovation in kind of creative minds, and they instill new ways of doing things. And that to us is why, as a venture capitalist, investing in this area is really interesting and important to us, because we think that notwithstanding the limitations today, all of those limitations will become kind of fodder for really interesting and creative entrepreneurs to figure out how do we actually advance the technology in a way that gets rid of those limitations and enables this to hopefully kind of transcend lots of the different challenges that we have today.
Yeah, great. So Scott, I think we have time for one more question, and then we can
awesome.
then we can take some questions from our members. So crypto market conditions, so similar to what we're seeing in public equities today and broader macroeconomic conditions, continue to weaken. There's been some of the more well-known tradable tokens are down 50% over the past month. And so maybe just what's your quick take on the current market environment? And for those of us that are interested in this space, and then for some of us that might be believers after this great conversation, what might be the best way for us to get some exposure in our portfolio?
Yeah, so I definitely cannot forecast, market changes on any given day, so I will refrain from doing so. What I will say is this, number one, look, there's the broader macro issues, which of course many people have spoken about and are much better adept at talking about, that obviously impacts things like frontier technology. So you see this in the public markets today, right? If you look at the high growth technology companies, many of those, to your point, John, also are down 50, 60, 70% from their highs. And so some of this is just, there's always going to be, when we have changing and uncertain macro conditions, risk assets more generally, obviously, will have some impact. I think, though, the way I would think about this is, kind of take a step away from kind of what the price movements look like and try to think about, okay, like what could the long-term opportunities be here? And this is really fundamentally what we do in our business is we look for markets that we think are really big and interesting markets where even though the probability of success in some cases might be low relative to, a traditional investment you might make, if these things work, do they have the opportunity to create uncapped upside? And that's really what's exciting to us about this market is we think this is a frontier technology. We think we see a ton of new engineers and new developers kind of migrating into this environment. And, nobody should, you all are smart enough to know what's the proper asset allocation that you want to have for, frontier type technologies. But I think, for those people who are interested, I think the way to play this is you have to think about this as a very long-term venture capital business. And so you have to think about, 10 to 20-year time horizons in terms of, when the monetization may happen in some of these plays. You have to think about time-based diversity. So if you're, investing, you want to invest through cycles. You ultimately will decide, what percentage of your assets, you want to expose to those types of technologies. But I think that's the way to think about it. Some people, I think, have been confused by what I would call the liquidity trap, which is because many of these trade, people view them as, hey, I can just buy, a cryptocurrency just like I buy my Apple stock. The reality is, though, the kind of, maturation of these markets are very different. So I do think thinking about funds and, kind of fund structures for these things probably is a better way for people to dab their toes into the water.
Thank you. So it looks like, just looking at the clock, we have a time for a few questions from our members.
So if you'd like to ask a question, we've got a microphone right here. Who's brave enough to ask Scott a question?
Okay, thank you, Mr. Cooper, for your comments today. I guess I have a comment and then a question, and that is, Warren Buffett defined cryptocurrency as something that you don't own, and it doesn't, you can't touch it, you can't feel it, doesn't make anything. Bill Gates just said last week in the financial papers, said that cryptocurrency is based on the idea that I'm going to buy something that's not, I can't touch or feel, with the idea that next week somebody's willing to pay more for it than what I paid for it. So as an individual investor at the 8th grade level, tell me why I should be investing in cryptocurrency. What's good about it and what's bad about it for me? Thank you.
Yeah, sure. So that's a great question. So let me try and kind of see if I can explain it to you. So The reason, the theory on why cryptocurrencies over time will be more valuable is, as I mentioned, they become kind of the economic engines for many of these applications. So let me see if I can give you hopefully a simple example. So if we were to decide tomorrow that we want to kind of recreate Uber in the form of a crypto company as opposed to the traditional way it works today, we would, we'll just make it up. We would invent something called the Uber coin, and we would create this kind of ride sharing service. And the coin itself would have some properties. We would define how many of them might exist over time, in software. That would be kind of, a permanent structure. And then we would say, okay, there's, the Uber coin has a couple of uses. Number one is if you want to kind of, take a ride share on Uber, you use this Uber coin as the form of kind of transaction for that system. And then secondly is if you are a participant in the system, you might, get some Uber coin as in exchange for that. So for example, when Uber first started, they went into new markets and they had to kind of seed a new market in Florida, for example, in Miami. And so they basically had to kind of subsidize drivers in order to create enough supply so that, consumers could, of course, use the system. And so those drivers were very important to the development of the system. Now, of course, they got paid for, basically providing a ride to people, but they didn't have kind of, any economic link between their activity and the development of the company. And so in the new case, if we build Uber as a Web3 company, we would probably, that organization would probably also give Uber coins to those, individuals who started driving in those markets as a way to basically incent their kind of participation in the market. So in the fullness of time, then the value of that token, that Uber coin, will reflect the value of the transactions, the utility that's happening on that system. So if Uber coin is the mechanism for buying a ride, and we have a fixed number of Uber coin, eventually the value of that coin will increase commensurate with the activity that's happening on that platform. So that's the kind of theory on why, even though it's a digital currency, and you're right, you can't touch it, you can't feel it, that's the theory on why the currency has value, which is it becomes the economic model by which transactions happen, and ultimately the kind of measure of utility gets reflected in the value of that coin. So I don't know if that helps or that makes it more complicated or not, and I'm happy to have a broader conversation, but in the limited time, hopefully that at least gives you a perspective about how to think about it.
Thank you. Any other questions? Dave?
Hi, thanks for being with us today. So you took us into that a little bit where I can get understanding. And as I look around the room, a lot of us were probably late adapters to something called Facebook. And then, if you look around the Facebook kind of ether, now it's largely populated by more the type of people in this room than the next generation who've moved on to another thing. So I think that this may be coming. But my question was associated with what might these companies that you've mentioned, what have they produced so far on their platforms that you could point to that's saying, hey, I can't even remember the name of the couple that you mentioned. What have they done so far that would say, hey, Bill Gates, this company has already done that, other than just trading stock values on paper? And then maybe if you could also address just some of the general security type of concerns that are out there as well.
Yeah, so let me talk about security first. I think security is important. We didn't touch at all on the fundamental underlying security that's behind all this, which is why the term cryptocurrency actually exists. That crypto actually is for cryptographic. And so the idea of one of the things that obviously these Web3 platforms create and provide is a much greater level of security, particularly around things like security of user information and other data. This is why financial transactions, by the way, is one of the first use cases for many of these currencies, because they do enable a greater set of security using these very advanced cryptographic technologies. So I think in that respect, it's very important. Now, you're right. What we have seen is other areas where things have been people have had things stolen. In part, those are being stolen because in some cases people are managing these things with kind of outdated security methods. But the fundamental data security layer is actually very, very strong. To your earlier question around applications, look, the early instantiations of applications have been in two areas. One is the decentralized finance area that we talked about, and there is a significant volume of activity happening there. The second is some of you may have heard of things called NFTs, which stands for non-fungible tokens, but basically think of them as a way for, in many cases, creators to be able to kind of monetize the value of their personality. So today, if I'm a singer I might go to YouTube or something, and I kind of work through that platform. The idea that we see in crypto in many cases is entertainers in particular using NFTs as a way for them to kind of go direct to their consumers, to their patrons, basically, and be able to monetize the value of their personalities through that. So those are some of the early things. The other area, by the way, we've seen a lot of activities in the gaming space. So I don't know if there's any gamers there, but the idea within games of being able to also have tokens and other things that kind of enhance the state of play of the game. Many of those exist today kind of within a game itself, but they often aren't kind of portable and available to be used in other games. That's another example today we're seeing. So look, we're certainly early, and I don't want to suggest differently in terms of kind of the use cases for these applications. My hope over time is what we will see is really some phenomenal, kind of world-changing applications. So I'll give you just a very simple example. Each of us has lots of medical information over time that could be interesting to help pharmaceutical companies develop drugs. Now, of course, nobody wants to kind of just give that information out willy-nilly. One of the beauties of the cryptographic technologies that this enables is that we could each kind of have a highly secure version of our medical history, on the blockchain, and we could determine at what point in time we want to make that accessible to a medical center, to a pharmaceutical company or others, to help kind of advance science in a way where that information is protected, and that where we govern kind of who gets access to that, and quite frankly, for what economic model. And so there's things of that sort where kind of data privacy and the ability of the user to control his or her data, I think, become really, really interesting use cases over time that could have, very, very broad opportunities for not only investment opportunities, but also kind of, broader kind of health and social welfare opportunities.
Scott, thank you very much for speaking with us today. It's very helpful.
You've been listening to Scott Kupor, investing partner with Andreessen Horowitz, speaking before the Economic Club of Florida on June 21st, 2022 in Tallahassee, Florida. For more information on Andreessen Horowitz, visit a16z.com. The Economic Club of Florida promotes interest and enlightenment on important economic, political, and social issues of the day. To learn more, including how to become a member, visit our website at economic-club.com. This program was recorded at the Florida State University Alumni Center in Tallahassee, Florida.